Imagine you have 70 lakh rupees and want to buy an expensive car. Would you pay cash or take a loan? A 70 lakh car is a major financial decision, not just a purchase. Today, we'll break down the economics of buying an expensive car. We'll compare cash, car loans, down payments, investment returns, and the hidden costs of ownership. At first, buying the car with cash seems simple. You pay the money and own the car. But spending 70 lakh rupees at once means giving up the opportunity to use that money elsewhere. And the car itself requires a large amount of capital before you even start driving it. So one alternative is paying 20% as a down payment and financing the rest. In our example, 20% of 70 lakh is 14 lakh rupees. That leaves a 56 lakh rupee car loan to repay over time. But a loan means you're not just repaying the amount you borrowed. You'll also pay interest to the lender throughout the loan period. So the next question is, how much will that monthly payment actually be? The answer depends on the loan amount, interest rate, and repayment period. A longer loan can reduce the monthly payment, but it can increase the total interest paid. A shorter loan usually means higher monthly payments, but potentially less total interest. Now we have two choices: pay 70 lakh in cash or finance part of the car. And this is where the interesting financial question begins. What should you do with the money you don't spend? In the loan scenario, you borrow 56 lakh rupees to finance the car. Your monthly EMI will depend on the interest rate and the 5-year repayment period. Every month, part of your payment goes toward the loan principal and part goes toward interest. Over time, the outstanding loan balance gradually decreases. But the interest payments can add a significant cost to an expensive car purchase. Choosing 3, 5, or 7 years can dramatically change both the EMI and total interest. That's why comparing only the monthly EMI can give you an incomplete picture. Now let's compare the two strategies directly: paying cash versus taking a loan. With a cash purchase, the entire 70 lakh leaves your bank account immediately. After that payment, your car is fully paid for, but your liquid cash has fallen significantly. With financing, you pay 14 lakh upfront and keep more capital available. That remaining capital could potentially be placed into different investments. For example, you could compare fixed deposits, debt investments, or diversified index funds. Each investment has a different level of risk, liquidity, taxation, and potential return. If the investment earns a return higher than the effective cost of the loan, the strategy can potentially work in your favor. But investment returns are never guaranteed, and taxes can reduce the amount you actually keep. So the real comparison isn't simply interest rate versus investment return. You need to compare the loan cost, after-tax investment return, risk, and your personal cash flow situation. But the loan payment isn't the full cost of owning an expensive car. Insurance can also become a significant annual expense for a high-value vehicle. The more expensive the car, the more important it is to account for insurance in your budget. Then there are maintenance costs, servicing, tires, brakes, and unexpected repairs. Luxury and performance vehicles can sometimes have particularly expensive maintenance. Fuel is another recurring cost, especially if the car has high fuel consumption. Over several years, those fuel expenses can add up to a substantial amount. And then we have one of the biggest hidden costs: depreciation. A new 70 lakh car may be worth considerably less after several years. When you eventually sell it, the difference between the purchase price and resale value is part of the real cost. That's why we need to calculate the total cost of ownership, not just the purchase price. We can combine EMI, interest, insurance, fuel, maintenance, and depreciation. We also need to consider how much cash remains available after buying the car. With a cash purchase, your bank balance can fall sharply on day one. With financing, you keep more capital, but you commit yourself to monthly payments. Over 5 years, we can compare those payments with the growth of the investment portfolio. The key question becomes, does the investment growth compensate for the cost of borrowing? And that comparison brings us to the final financial decision. Now let's put the two strategies side by side over the same 5-year period. Strategy 1 is simple. Pay the full 70 lakh rupees in cash. Strategy 2 is 14 lakh down, 56 lakh financed, while the remaining capital is invested. The important calculation is the total loan interest compared with the investment's potential growth. We can test different investment return scenarios because actual returns can vary. And remember, the return you receive after taxes is what really matters. So the key formula is after-tax investment return versus the effective cost of the car loan. If borrowing costs are higher than your realistic after-tax investment return, financing may not make financial sense. There's another factor people often forget: your emergency fund. Buying a car should not leave you without enough accessible savings for unexpected expenses. Your income, existing debt, savings, and an investment portfolio should all be considered before taking a large car loan. And don't make the decision based only on the EMI you see in an advertisement. The real cost includes the car price, interest, insurance, fuel, maintenance, and depreciation. After 5 years, compare the total money spent and the investment value remaining under both strategies. The better option depends on the actual loan rate, investment return, taxes, and your financial situation. So should you pay cash or take a loan and invest the difference? There is no universal answer. The smart approach is to compare the numbers, protect your emergency fund, and understand the risks before deciding. Because an expensive car isn't just a transportation decision, it's a financial decision, and the math should come before the keys.